What's up, everyone? It's Jayden here. Today, we're diving into one of the most mind-blowing parts of how our entire economy actually works behind the scenes every single day. Have you ever wondered what really happens when you deposit money in a bank? Most people think banks are just giant, secure safes storing cash forever inside. But that's not how it works at all today anymore. Banks don't just store money safely. They actually create it themselves digitally now. Yes, literally create brand new money out of thin air whenever they approve loans. Sounds completely crazy at first hearing that, right? We'll cover whether banks can create endless money, how they earn profits, and how they can lose badly. We'll also explain why this system exists, what can go wrong, and why it matters to everyone. Let's begin. When most people picture banking, they imagine something simple. You deposit money, and the bank locks it safely inside a giant secure vault forever there. Then when another customer needs a loan, the bank supposedly takes part of your deposit and hands it over directly. That story feels logical and believable, but it is not how modern banking systems actually work behind the scenes today anymore. This old explanation is often linked to something called fractional reserve banking, but most people misunderstand what that phrase truly means. The word fractional simply means only part of something, while reserve means special money banks use between themselves daily. For example, if you transfer money from Bank Alpha to Bank Beta, reserve balances move between those banks electronically. These reserves are not cash you can hold. They are electronic balances used inside the banking system only. They do not leave the banking system, and they are not directly loaned out to the public ever. Also remember this carefully. Reserves do not come from your deposits at all in the first place originally. If banks need more reserves, they usually borrow them from central banks or other banks instead there. So what did fractional reserve banking traditionally mean in practice? It meant banks did not need reserves equal to all deposits held. Let's make this easier with a clear example now. Imagine a bank called Blue Sky Bank opening for business today. 10 different people each deposit $1,000 there, giving Blue Sky Bank $10,000 in total customer deposits altogether. Now assume Blue Sky Bank also has $1,000 in reserves from earlier transactions or borrowing from elsewhere already. Then a borrower named Daniel walks in and asks the bank for a $1,000 loan today urgently. I need the $1,000 today, urgently, please. All right, let's review your papers. If rules require 10% reserves against deposits, Blue Sky would need at least $1,000 in reserves available there. Since the bank already has $1,000 in reserves, it meets the rule and can approve Daniel's loan. When Blue Sky approves the loan, it does not hand Daniel another customer's money from their account directly there. Instead, the bank simply credits Daniel's account with $1,000, creating a brand new deposit instantly on screen there. Now total deposits become $11,000. The original $10,000 plus Daniel's newly created $1,000 deposit balance. Meanwhile, the bank's reserves remain exactly $1,000, showing that lending increased deposits without increasing reserves at all in this simple example. With $11,000 in deposits, the bank would need $1,100 in reserves to meet the 10% requirement. But since it only has $1,000 in reserves, it can no longer approve new loans under that traditional system rule. That was the old textbook explanation of how lending was limited by reserves, but modern banking systems no longer operate strictly this way. In many countries today, banks are not required to hold a fixed percentage of reserves before issuing loans at all. In fact, in some major economies, the reserve requirement has been reduced to zero, completely removing that traditional constraint on lending. That's why many people say banks create money from thin air, because lending is no longer directly tied to existing reserves. But even without reserve limits, banks still cannot create unlimited money because real-world constraints come into play immediately after lending happens. When borrowers spend their loans, the bank must handle withdrawals and transfers, which requires actual cash and reserves to settle those payments.
For example, let's continue with Blue Sky Bank, which now has $11,000 in deposits and $1,000 in reserves after Daniel received his loan.
If Daniel decides to withdraw $300 in cash, the bank must physically provide that money from its vault immediately. If he then transfers $700 to his landlord at another bank, Blue Sky must send that amount using its reserves. So even though banks create deposits when they lend, they still need enough cash and reserves to support customer transactions afterward. Now let's talk about how banks actually make money, starting with the most obvious source, which is interest earned on loans. When Daniel repays his $1,000 loan with an extra $200 in interest, the bank earns that interest as profit. Banks also earn money by investing in safe assets like government bonds, which generate additional income over time steadily. However, if borrowers fail to repay their loans, the bank must absorb those losses using its own capital or reserves. This shows that even though banks can create money, they still face real risks and cannot operate without limits or consequences. But remember, the bank already lost that $1,000 earlier when Daniel spent it, so only the interest becomes true earnings. At this point, you might wonder why such a system exists at all, since it seems both powerful and potentially dangerous. The reason is simple. Modern economies rely heavily on credit to grow faster than they could using savings alone. Businesses borrow to expand operations, families take mortgages to buy homes, and governments borrow to build large infrastructure projects. Without bank-created credit, economic growth would be much slower because spending would depend only on existing saved money. However, this system also comes with serious risks when banks lend too aggressively and too much money enters the economy quickly. That can inflate asset prices like housing or stocks, creating bubbles that eventually burst and cause widespread financial damage. At the same time, heavy lending weakens banks because customers withdraw cash or transfer funds, reducing reserves and available liquidity. If too many customers demand their money at once, the bank may not have enough liquid funds to meet those requests.
We want our money! Give us our money now!
This situation is known as a bank run, and it can quickly lead to the collapse of even large financial institutions. When one bank fails, panic can spread, causing people to rush and withdraw money from other banks as well. To stop this, governments or central banks may limit withdrawals or temporarily close banks to prevent further panic spreading. But these actions can sometimes increase fear, creating a chain reaction that can destabilize the entire financial system. Capital represents the bank's own funds used to absorb losses, while liquidity refers to how easily it can meet payment demands. If these become too weak, the bank must slow lending or risk failure, which is why banks carefully choose who they lend to. So in conclusion, banks do not simply lend out deposits. They create money through loans and manage real constraints behind the scenes. Today, the main limits on bank lending are not reserve requirements, but capital strength and liquidity management within the bank itself. This constant cycle of money expanding and contracting is what drives the modern economy and influences financial stability worldwide. And that's why when banks begin to fail, the effects spread far beyond finance and impact the entire economy. So next time someone says banks create unlimited money from thin air, you'll know the reality is far more complex than that. If this video helped you understand banking better, drop a like, subscribe, and stay tuned for more deep financial breakdowns.